Here we go. Good day. My name is Bruce Bolger. I'm founder of the Enterprise Engagement Alliance, and I'm here to share with you today our course on human capital metrics and return on investment and measurement. And this is class 5 of the formal Enterprise Engagement Alliance learning platform that's designed to provide the world's first education program on stakeholder management. That is, engaging all stakeholders toward a common organizational purpose, breaking down the silos between external and internal marketing, and implementing a metrics measurement-based approach to people management. So for this session, we're going to kick off a little panel discussion with Allan Schweyer. He's executive consultant and research and writer on all areas of human capital. He's trained as an economist, worked with him for years, and he's with the senior advisor to the Center for Human Capital Innovation, and he's co-research chair for the Incentive Research Foundation. And we have Todd Hanson. He's founder and CEO of Catalyst Performance Group, and he's an expert in business operating systems and also in ROI of engagement, measurement of human capital practices. So we work with him frequently as well. So thank you, gentlemen, both for joining us. And just a quick little housekeeping matter. Well, actually, there is no housekeeping on this, so I'm going to stop the share. And thank you both again for joining us. So, Allan, you've been involved probably for about 20 years now in the whole human capital arena, in research on incentives, rewards, recognition, motivation. What is the maturity level of measurement and management of people management in organizations today? Is it mature, or is it like in manufacturing? Do we have really strategic and systematic processes, or does it still remain early stage? What's your view on that?
Well, I think we have a large and growing toolkit, for human capital measurement. If you think back even 20 years, the work that was done in the employee engagement, profit supply chain or value chain by Sears and others was, really incredible work at the time. Since then, of course, we've added a great deal of predictive analytics capability, AI, machine learning, ROI measures that Todd is an expert in, and we have books. John Boudreau, Dave Ulrich, consulting firms who have put out remarkably good material on how this is done. But to answer your second question, no, I think most organizations, the Googles aside, there's a more than a handful of companies and even government agencies that are well along that maturity, human capital measurement metrics maturity line. But the vast majority are still, collecting data, really reacting to data that, is maybe 6 months old, not using the predictive analytics capabilities, even embedded in Excel, let alone using more advanced, SPSS and other types of software. So even though I think the tools are there, I think we have great examples from different organizations. I think we have really good academics, consultants, and other thought leaders who have really shown the way on this. Most organizations have either maybe deprioritized it, or maybe they don't have the expertise or feel they don't. But yeah, I think the level of maturity is still sort of stuck in the bottom quadrant, certainly the bottom half of that. If you look at a 45-degree angle sort of maturity scale, with predictive analytics being towards the end. Yeah.
And we'll get to the trends on that in a minute. I'll get back to you on that. So Todd, you do a lot of work with owners of small to medium-sized businesses, who many of them are on a fast track. And there really is this discussion today: are people a human resource that we manage as a resource, or are people capital? Are they an asset? If you had to honestly say, and I know you've met a lot of business owners and worked with a lot of business owners, deep in their hearts, do they view people as capital or as a resource and as a sunk cost in a sense? Generally speaking, always exceptions.
I think that in their head, in their heart, they really know that this is capital. This is something that's precious. And I think that the pandemic made it painfully obvious that without people, I mean, you've got nothing, right? So we had lockdowns, and it didn't matter what kind of industry you were in. It's like, unless you got people doing great work, in a predictive manner, you've really got nothing. So I think the barrier, and I would agree with Allan in that it's probably the bottom quartile in terms of business owners, that one will recognize the importance of taking care of their human capital and investing in it, and then doing anything about it to truly evaluate it and be proactive rather than reactive. It is easy to be reactive. You get bad news, something's broken somewhere along the way, and now we go fix it. But it is better than it has been. And this 20-year benchmark, there is great progress in subject matter experts and in tools and software and apps and things like that. So we're making progress. I think that it's the paralysis of analysis that affects small and medium-sized businesses. It's like, where do I start? Am I really an expert? And I mean, that's one of the things I try to talk to small and medium-sized business owners is, let's just get started. Let's really simplify it. And then they can move up that continuum that Allan described.
Now, this leads to the question, what you've just said, Todd, back to Allan. Do you think that let's face it, on balance sheets, the only thing that's on a balance sheet is tangible assets. But look at it, look at all the hotels, airplanes, restaurants, factories whose tangible assets were completely, in a sense, valueless, because the 80% of the intangible assets on the balance sheet weren't there. So my question to you is, Allan, do you think that the pandemic might have changed things permanently? Or is this a short-term, this sort of growing awareness of people will go away when the plague has left us?
No, that's a great question. And, no one obviously has the answer, but, Todd had mentioned the pandemic had changed things. For the big example is there's a mass movement to remote work. This trying to get people back into the office now that the pandemic has receded a little bit has failed for the most part. And that's because employees are collectively putting their foot down and their feet down, I should say, and not coming back to the office, refusing in many cases, and quitting if they aren't given that flexibility. So I think the flexibility cat, if you will, is out of the bag for a while, if not forever. People have got a taste of it. Not only that, they've proven in most cases that despite the distractions, kids working from home, the worry of catching a disease, all the things that were stacked against people who work from home or weren't prepared to work from home are overcome, and productivity is actually higher across the board. Commutes are eliminated, and that productivity is going right back to the benefit of the organization. So I think, we've done a lot of research on this at the IRF. We have 2,000 responses to a survey we put out, first batch in April, second in late May. And even in that short period of time, the managers, of which of the 2,000 were about 750, demonstrated a significant greater comfort level with their teams working from home. So managers were thrown into this without the tools or experience to manage a virtual workforce. They're learning quickly. I think organizations are providing more support. I think, yes, there will be a long-term implication where American workers will finally, since the days of unions, more stand up and say and demand less toxic work environments and more flexibility. The last thing I'd say is there's a recession caveat. If we had a deep and long recession, which doesn't happen very often, even the 2007 recession didn't last more than a few years, but in those circumstances, the pendulum swings back towards the power. The pendulum swings back toward employers. Some employers will take advantage of it. Some will try to use it to bring people back in the office, but that's a short-term win for them. As soon as the economy picks up, those people's resentment will show and they'll suffer more attrition. So yeah, long answer to a great question. I think it's long-term.
Well, I'm going to give you one easier question as a transition to Todd's and the remainder of our program. And that is in getting more practical. Todd and I are going to be talking about the application of some of the work you've done over the years. The master measurement model, which you weren't directly involved in, but that was work that the IRF owns, and other measurement process. You've been a big advocate of testing in the incentive world. Don't just run a program, structure the rules, think about it, communicate it, compare it to maybe how you're doing it elsewhere, that view this scientifically. I think you've already stated that we're probably in the early stages of that, but do you see any advancement you're at the front end of that industry? Do you see that industry moving more toward measurement, more toward testing, more toward being scientific, or is it still sort of the companies that believe in these reward programs will continue to do them out of faith, and those that don't believe in them won't do them out of their own faith, and the status quo continues? Which is it? Move toward more measurement or status quo?
Well, I interview an awful lot of people, annually, maybe 50 or 60 experts in this area for my research. So we'll do, survey type research and then interviews and focus groups. And in those interviews and focus groups, this question comes up because they couldn't really answer the question very well if they weren't doing some form of measurement. So, I think it's improving. We've done a lot of research since the master measurement model and published papers into, things like the ROI of incentive reward programs, which Todd can speak more to, but also ways of measuring, engagement and real business impact from an incentive program. So I think there's more attention to it. I think it becomes more a priority in tighter budget times. I think right now, organizations are doing what they can to reestablish relationships and trust. So, for example, an incentive travel program may not come under the scrutiny it might have even just before the pandemic in terms of measuring it and proving its value. I think, leaders are saying, you're going to bring my people together who are working remotely, my best performers in one place. I get the value. I don't need you to necessarily prove it.
Interesting.
Yeah. So, Bruce, this is dependent on the organization, dependent on the industry, dependent on the economy. But overall, yeah, I think gradually we're seeing more attention paid to measurement in this industry.
Well, I think the big driver, Allan, and thank you for joining us, is going to be a force called capitalism. I think that the driving force for a greater focus on human capital measurement is the ever-striving desire to make a buck. And I think the argument is that the last bastion of value creation is in people, in recognizing they're not a sunk cost, and in recognizing that very much it's like total quality management in the 80s. And you've heard me say that many times. Companies built in massive inefficiency into their bottom line. They could get away with it. And then the Japanese set a new standard of quality, and Americans voted with their feet. And Japan permanently changed the US marketplace, permanently. Sure, we regained a lot of market share, but we never, ever regained the domination that we had. So I think it's a lesson to business, and I think that's what's going to drive it. But I've learned a change of this nature is a generation. It takes a generation. People say, Bruce, why do you persist? Because it doesn't take a year. It doesn't take 2 years. It takes a generation. And Allan, you've been at it for 20 years, and I hope to be on the journey with you for another 20. So thanks again, Allan. And now you've given us a good opportunity for Todd and I to get down into the nitty gritty. Thanks again.
Okay, well, thanks for the invitation. I appreciate it. And
okay.
Yeah.
All right. So
and hey,
Todd,
Bruce, can I just add one thing to
sure.
To maybe expand on what we've shared? So yes, capitalism will tend to drive the right behavior within the marketplace. Besides the pandemic and the crisis it caused and the things we're all aware of and that Allan was talking about. The other thing that has been wonderful as it relates to creating the right dynamics for an organization to invest in their people is the fact that it's hard to find people, right? I mean, it is, all the chips now are owned by the employees. It used to be in recruiting process, it was 20% vetting the employee, 20% selling the company, 80% vetting the employee, and that's flipped completely upside down. And so not only in the recruiting, but focusing on engagement and retention, all the dynamics have changed. And so I think the lesson has become a little more poignant and a little stickier. So I'm encouraged by that.
Well, thank you. And now we're going to dive into it. And Todd, I'm just going to take about 10 minutes. I'm going to go really quick, so don't go away.
Okay.
Don't eat lunch yet, okay? Hold on there. All right, folks, I am now going to focus quickly on going through top line concept of human capital, about the overall issue. And so one particular measurement tool that I was involved in the development of, called the master measurement model, did not create it. It's a standard statistical process control. And then I'm going to turn it over to Todd, who's going to get in very quickly to give you an overview. And all of our textbook covers this at great length. And so there are plenty of opportunities to get into it. But human capital reporting has been driven by the Securities and Exchange Commission, which now requires all public companies to report on their human capital to the extent that it's relevant to their material to their business, which gives them a wide range. And there's been with human capital reports, you now find them in all 10K reports. And these will explain issues of they have to say how many employees they have. And then these issues talk about diversity, equity, inclusion, employee engagement, employee turnover, employee well-being. There's no standardized way of reporting on it, but there's a growing view that human capital management, and that is the sum total of all of our employees, are an asset, not a resource, and that the asset can improve in value if we invest in it in a measurable way. And so that is why investors increasingly are put for this information. A recent study by professors at Columbia and Harvard Business School found, in fact, that this new requirement did push companies to produce more information than they did before, and that those companies in industries that have are very dependent on people, their stock improved, their share prices improved when they reported and issued these 10K reports with their detailed human capital reporting in compliance with Sustainability and Accounting Standards Board standards. So there's a concrete evidence that human capital reporting can affect share prices. There are many different metrics coming out. There's the Integrated Reporting Standards, the Integrated Reporting Council, which is consolidating standards. There's ISO standards, which I'll talk about in a minute. The Securities and Exchange Commission right now is about ready to announce, we understand, new metrics-based recording standards for public companies. And these affect all companies. These affect companies that do business with public companies. These affect companies that are private equity funded. And again, this is being driven by investors, ESG investors, environmental social governance, people concerned about people, and more major companies like Merck, Best Buy, EY, Microsoft, SAP publish human capital reports. ISO 30414 is a new standard. 5 companies now have announced compliance or conformance with this standard, and it basically tracks all of the ways that companies manage their internal people: compliance, cost, diversity, leadership, organizational culture, occupational health and safety and well-being, productivity, recruitment, mobility and turnover, skills and capabilities, succession planning, workforce availability. And these metrics are directly related to an organization's financial benefits. Organizations do not recognize the link between human capital ROI and business results. And that's where companies are overlooking the ability to create value, just as they did during the total quality management revolution in the 90s. They learned that by lowering defects, they could actually improve profits. So the whole concept of creating a strategic and systematic approach to viewing people as an asset is a business opportunity, not a compliance tool. What makes ISO standards or standards like that different than these great places to work or these other types of standards is that ISO focuses very much on methodologies. What is the purpose of the organization? What are the objectives and goals of the organization? What are the purposes of its leadership practices, of its DEI practices, of its organizational cultural and health or wellness and safety? What are its goals? What are its practices? What are the methodologies used to measure progress toward achieving those goals consistent with the organizational purpose? That's what makes the ISO standards unique. It's not just a matter of compliance, and it's not just a matter of costs, although these are covered in the ISO 30414 standards. And these are right here very important. Two of the most important human capital calculations that most companies overlook. That's human capital return on investment, and the formula is right there. If I speak it, you're not going to remember it, but you can Google human capital return on investment or refer back to this slide. Human capital value add. That measures the profit an average employee contributes to the bottom line. And this is calculated quarterly. And so these two formulas, if you track them over time, correlate oftentimes and will be predictive of your EBITDA. Moving on quickly then, these again are many of the different types of measures that a company can follow: diversity, leadership development, national occupational health and safety and culture. Some of the key employee statistics. These are numbers that you can correlate with your financial results. Another critical one is per customer or per employee. What are their revenues? What are their costs? What's their willingness to refer? Nothing more powerful than employee willingness to refer. Employee engagement surveys, well, they do give you some degree of utility, but they don't do what you really need them to do, which is to predict people's contribution to your bottom line and to your goals. Very quickly, the Incentive Research Foundation has a very powerful tool called the Master Measurement Model. We explain it at length in our textbook. It's a simple and easy to use process to build ROI measurement into any process. We explain it further in our class on case studies. But essentially, it's a matter of identifying the people critical to a goal, setting realistic goals based on what's been accomplished in the past. It's looking at everybody that could affect the outcome of that goal. Don't just look at the employees within your group. It might be other employees. You want to develop 3 to 5 measures, no more than 5. 3 is usually the best. 1 being a result measure, the actual goal, others being steps which, if done more, would yield to that goal. Assigning a dollar value to any goal is always useful to give you sort of it might be an intangible goal, one that does not have a clear value, but in many cases they do. If you're willing to give points for some behavior, look at the value, of that behavior of the organization. Identify potential obstacles to your goals. Once you've implemented your plan, monitor the results, make sure you're communicating, that you're making sure people are learning, you're giving people an opportunity to get recognition along the way, make sure there's a sense of community. And remember, ROI isn't just numerical, they're qualitative returns on investment. Make sure the measures are easy to collect. And again, the reason you measure is for continuous improvement, which is now, Todd, your cue to join us back. So hopefully Todd has not gone out to pick apples at his beautiful farm in northern Wisconsin. So Todd, we need to respect people's time. I'm going to turn it right over to you and I'll advance the slides for you.
Awesome. Thank you, Bruce. So why on earth would you really measure the results of any investment in engagement? And I've been around long enough to go through these incredible cycles of high peaks and deep valleys in terms of investment and sentiment as it relates to investment in human capital. And there are many reasons that I'm covered here in the graphic. One is to defend current spend. In many cases, things get a little tough, and look, we try to do an analysis of our investment and are we getting any kind of return? Well, without the results, I mean, the data associated with measuring results, you can hardly just defend it. And justifying future spend, same kind of thing, right? We're going to spend the money. What's it going to drive in terms of results for us? The other is accountability, right? Hey, we're going to use this money wisely, and the results will tell us how we're doing, the good, the bad, and the ugly. But most importantly, when we evaluate results, and this is just so critical, is it drives this continuous improvement that you mentioned, Bruce. Next slide. So I believe that every time that you go out, you've got the design phase. We're going to come up with a rule structure, a budget, how we're going to promote it and communicate it, fulfill, and then we move into the fulfillment stage, whatever that may be. It's, implementation. And then the third part of this cycle is skipped. We move on to the busyness of business, and we're not evaluating results. And it's kind of a natural phenomena. But if you look at the evaluation of the results of anything related to engagement and investment in human capital, it just is so smart. It drives this continuous improvement that is indeed fact-based. So completing the cycle is just so important if you really care about in your investment. Next slide. So how do you go about doing it? It kind of seems complicated, overwhelming, whatever. Well, from the ROI Institute, the ROI methodology, which is indeed the gold standard across the globe, it's evaluation levels broken down according to this pyramid here. There's 5 levels. Next slide. And so the reaction and planned action is level 1. And we're really talking about satisfaction and reaction to whatever's being done, heads and hearts, which I'll talk about in just a moment. Then there's the learning or understanding. In some cases, we're trying to impart knowledge, information, skills, and contacts. Or in some things, we just want to make sure that the nature of an incentive program or rewards and recognition are truly understood. Nothing worse than actually investing in your people and they really don't understand what is that being requested of them and what does success look like. Level 3 is a fun part. Hey, what's going on in the workplace? So it's application and implementation. So what are the changes in the workforce? And then of those changes, some are going to create business impact. Some of these business impacts we can monetize, and we can, when we monetize it and compare it against our investment, what did we spend? Now we can actually calculate a return on investment in language now that resonates with a CFO. Next slide. So this whole concept of engagement, remember going way back with Enterprise Engagement Alliance and a panel as we talked about what is it? Is this fuzzy, nebulous thing. Maybe we see it when maybe we know it when we see it, but we condensed it down at that time to just proactive and positive involvement. And you have to start here, because the next slide, please. If we're not moving the needle, we know, and here is a white paper with the data that'll pull up here on the right side of the screen that shows that engagement pays off. Or the flip side of that, and Bruce, if you'll advance the slide and we'll get the text there. If you don't have engagement, it costs a lot of money. Next point there. At that time, it was $350 billion. All right. And now there is new data, and disengagement costs U.S. economy a tremendous amount of money. So we must capture these heads and hearts and then move forward, because next slide. There is this chain of impact, right? We all want a financial return on our investment. But if you're not capturing the heads and hearts, how people react and are they satisfied with a program that you perhaps have rolled out, then nothing else really can happen very well, right? So level 2 in large part is contingent upon, hey, the heads and hearts in level 1, engagement or reaction and satisfaction, and level 2, learning or understanding, which obviously allows us to anticipate behavior in the workplace. So we've got application and implementation. And we know when we're modifying and impacting behavior in the workplace that certain things are going to be impacted, business measures. And again, those measures that we can quantify or actually monetize, we can now calculate an ROI that shows us, hey, we're spending this money and what kind of return on investment are we getting in dollars and cents. So that chain of impact is critical. And there is indeed a reasonable, doable approach to this, and it is the ROI methodology. Here is a data collection plan that breaks this down, right? It can be kind of overwhelming, seems a little complex, but hey, let's simplify. We've got 5 levels here. We establish our objectives. What are those measures? How are we going to collect the data? Where those data sources come from? And then timing and responsibilities. And this is in alignment then with the next slide. This very linear, simplified step-by-step process for the planning, the collection of data, the analyzing the data, and reporting. So this is what takes all this complication out of it, makes it simple and understandable. And there are several open source resources and tools available from ROI Institute that you can use to, again, take some of the complication and perhaps mystery out of it, but turn it into something that's doable. Next slide. So we go ahead and we plan an evaluation. We collect a lot of data. Now, what are we going to do? And there are many companies that do fail at this. And you heard Allan refer to that. Mountains of data, maybe reacting to it, or perhaps not responding to it and trying to understand what's predictive about this. So the real magic as it relates to evaluating results is now, okay, we're going to try to figure out what this is telling us. And an impact report is created. There's a summary of results. So we take all of our bar charts and distribution responses and we put it into a little summary of results. It includes key findings, barriers, and enablers. So it's kind of like the elevator pitch, right? But it can be condensed down. If you take a look at, you got to fill these various categories here. What are the key findings, the most important things that we learned, all right? And then barriers. Very important stuff to look straight in the eye, even though we maybe would prefer not to, because within the barriers, we're going to identify gaps that we could perhaps fill, as well as nothing is perfect, especially when we're involving investment in people, where, there's a lot of variables. What didn't work? And again, applying this to continuous improvement so we can get bigger, better, faster, smarter next time out. And then enablers of success, primarily capturing best practices and documenting those. And then the real gold that's buried in the impact report is an action plan. What action plan or action steps do we need to take to fill gaps, maintain momentum, to satisfy any concerns that may exist out there, and also then next time out with either the next cycle of this particular program or a new one, what did we learn and what do we want to make sure that we apply as we go forward? So that impact report is what turns all the data into something that's just really precious. Next slide. And you want to avoid doing this. That's the whole purpose, is like you can get overwhelmed with data. And this guy says, forget it, I'm going to the cocktail reception, right? So press past this mountain of data, which sometimes is created, and simplify, right? Key findings, barriers, enablers, and an action plan. Next slide. So ROI of engagement in action. Here's just an illustration to seed a few thoughts and ideas. This is a dashboard for a training department with a pharmaceutical company. And we were measuring level 1, reaction at the bottom there, level 2, learning. And then we actually created a little subcategory, engagement, and engagement as it related with the field sales force and then the sales training department. And so every time that training is initiated, or also leadership development, not only sales training, but leadership development, we would evaluate results. We would complete that impact report, make sure that there's an action plan that rolled out in the future. But also when you have a dashboard, again, turning data into something that's actionable, you'll see a couple of deep dips. That was just months where there was no data to be had. But you see that in some cases there was a trend downward. And guess what? Take that data, make it actionable, stop, time out. It's like, what are we learning? What are our participants telling us? Because we actually evaluated results. And what are we going to do to move the needle back up? And as you can see, in all the situations where there was a little dip, it ended up bouncing back because we used the power of measurement to enable us to, on a fact-based manner, get the needle back up to where we would like. Next slide. That's it for my part, Bruce.
Yes, I see that. Boy, you did that well, Todd. And
Yeah,
I'm actually, for those of you who are taking the certification program, again, the purpose of our whole education program is to make you, it's to understand you have to be a jack of all trades and master of none in many cases. If you're going to be an expert, you have to call it an expert. But when, just like in marketing, you have to understand all the different types of marketing. If you're in manufacturing or you're an engineer, there are many, many different facets of your job. So really the whole concept of enterprise engagement, stakeholder management, is understanding all these new tools. And Todd is actually an expert in two of them, business operating systems and measurement. So again, and part of the examination is going to look at your knowledge of the key issues. So human capital management, what is it? It's a formal practice. We're managing your employees and all stakeholders as an asset rather than as a cost. Name a method for measuring the return on investment, ROI of Engagement, the ROI Institute Master Measurement Model. What are the key ingredients for successful measurement outcomes? Todd gave a beautiful review that are both results and actions and different impacts, as you saw. What does the US SEC now require of companies? You might want to know about that 10K requirement. Why are these major organizations issuing human capital standards? Again, no one expects an executive today to be knowledgeable about all these different areas. So Todd, thank you so much for joining us and for helping in the multiple programs that you are in. And for those of you who are going through this program, we appreciate you being avant-garde, cutting edge in the new leadership model of stakeholder management. Bye-bye.
Thank you.